To what extent do you think China and Hong Kong will continue to be a drag?
So I would agree that it is sort of split into the two parts, although for us it's not quite as stark as that, because the GDP numbers for China are broad overall economy numbers. We are not a broad overall bank in China. We are a specialist in serving international corporates, particularly with cross-border activity. So what we've actually seen is import and export activity has been very strong into China, and hence our China business has actually done really well. It also actually posted about a 20% increase in income in this last quarter. So the bit that we do focus upon in China particularly has been very strong. And then, as you say, the rest of APAC, the Singapores, etc., really, I think, are pulling through now. COVID is becoming a thing of the past. And the talk about inflation that we hear of so much in the Western world is much less of a discussion in those markets. They're not immune from it, but it is not the biggest item.
More broadly, as we take a look at the business and the interest rate story, as you mentioned, 11% up in terms of the rise in interest rates, the net interest income. Stunning. I think many market participants looking at banks in a slightly different light to what they have over the past decade, finally having this net interest expansion story. But at what point do we see destruction from the growth story? Because now the concerns that we may see some sort of pause by central banks after all this aggressive monetary action.
I think when people look back over the last few years, they will realise that the combination of banks operating at very low rates of interest, which is economically challenging, plus COVID laid on top, has been quite a handful. Now that we're actually moving beyond the COVID era in most markets, probably China the exception, and we are seeing the rates coming back, but the rates are coming back to more normal levels. It's not like they're jumping to super normal levels, 3% interest rates by long-term standards. So I think what we're actually seeing is banks starting to get back into a rhythm, which I actually think for society is a good thing, because they need to be robust. And as governments like in this country start to get the economy going, the role that banks can play in that, if they're well capitalised and they're strong, will be much more influential.
I take your point about the direction, and if you compare historically where interest rates have been, but if you think about the consumer, business, retail customers, they are not used to this type of environment. Right. Very low interest rates for a long period of time. Now we're seeing rapid increases and even scaremongering too around what a fallout may be from a mini budget here in the UK.
Yes.
How do you think consumers will weather this economic scenario with rapidly increasing rates?
Yes, I think for a lot of consumers, you're right. 3% is 3 more than they have been used to. So in that sense, it is higher. But in a lot of the markets we're in, we're actually not seeing stresses in our credit book. The credit impairment charges that we took in the quarter were really down to 2 things. One, the country downgrades of certain geographies. And secondly, in the China commercial real estate area, which has been difficult, we took some charges there, as many have done. If you actually put those 2 on one side, we took very little charges on the rest of our normal ongoing activity. So do we monitor it? Absolutely. Are we wary of it? Yes, we are. But at this point in time, and particularly as the rates sort of come through, a lot of people are on fixed rate mortgages, so it doesn't impact immediately.